Let me welcome now Dharmesh Khan, the Head of Retail Research, India Nivesh. Dharmesh, good morning and welcome to the show. What do you make out of a couple of results? Number one, Bharti Airtel, how's it looking to you? And secondly, what's your reading into Biocon results? Both the stocks, they normally react by a good margin again after the results. So how we should be reading into the results?
Yeah, good morning. See, as far as Bharti is concerned, one should not be swayed by the net profits which they have reported, because on the operational count, things are still very dicey, and they have been losing market share. At the same time, ARPUs have come down. So margins remain a concern, and it's a constraint, and going forward, it's likely to be, the scenario is likely to be the same. So I think still, there's a lot of time before this entire telecom space get stabilized by the what Jio has done to the industry, and Jio has been gaining markets share at a rapid pace. So my own sense is, if one has to play this sector, again, Reliance is the safest way to play this out. So I won't be nibbling into the Bharti Airtel and leave it the stock price to do whatever it does. Biocon again has been there in the pharma space, and some erratic kind of numbers were observed in the last, if you look at 6-7 quarters, previous 6-7 quarters. So consistency is one thing which is still not established out there. At the same time, pharma space again comes with its own set of problems. So nothing majorly clear out there, though the currency thing has helped them to a large extent. So as a trade, I think one can accumulate as a basket of trade like Biocon, Sun Pharma, Lupin, Dr. Reddy's. It can be, today Dr. Reddy's would be reporting the numbers. So this can be accumulated as a basket, but it's more of a trade rather than a investment buy. So again, one has to be very clear when they're entering into the pharma space.
Dharmesh, another question on two stocks which are classic underperformers in the last 1.5 months. Yes Bank, results came. Maruti, again, results came. We had a reaction in the market time also. But what's your take on both of the stocks, their current valuations with respect to result, the growth trends, how are they shaping up?
Yeah, first on Maruti. See, the numbers which came yesterday, it was expected, though the surprise came on the profitability front, primarily because of the inventory adjustment which was there. So as the closing stock went up, that helped the PAT to come around 24-40 crores kind of a level. But essentially, if you strip that off, if you take it in a pro forma kind of a basis, then it was around 2,000 odd crores. We have seen on year-on-year basis, the Q2 vehicle sales were less than what it was in FY18, and going forward, even Q3, if you compare it on a year-on-year basis, the numbers won't be so, surprisingly good. So it will be a disappointing numbers, and that is my own sense. I think as far as vehicle sales is concerned, passenger vehicle sales, it has peaked out, and in a rising interest rate scenario with lot of uncertainty playing out, inflation going up, the fuel prices are up, so people normally defer their purchases, and this was reflected in the Q2 number. So valuation wise, though the stock price has taken a steep correction from around 10,000 odd levels to 67, 6,800, but still I don't find it's a decent buy. Maybe around 5,500, 5,700 one should start looking at Maruti. So I am bearish on Maruti as of now for the next 2 quarters, and then we'll see how the things pan out. Yes Bank reported the numbers, and now the things are falling into place as far as asset quality is concerned. They have again provided for one of the asset, and they said that Q3 would be the quarter where they are likely to recover that. But having said that, what they have done is they have provided for it. The point of contention was when they came out on 1st of October, the gross NPA levels, they reported that it would be 1.35%, but subsequently it came at 1.6%. So in 15-20 days, this kind of a divergence is not liked by the markets. Business momentum is likely to decelerate. It would fall below 20% kind of growth, and in the scenario when they have to fix up a new CEO and the senior management may undergo a change. So the trajectory would be slow down in the overall business of Yes Bank, and asset quality, ILFS exposure is also there. So they are maintaining it as a standard asset, but you don't know how the things are going to pan out. So the stock will remain under pressure. My own sense is any upticks on Yes Bank will be sold into. Valuation wise, let's not look at the historical multiples which we have given to Yes Bank. First, this seems, let the scenario be cleared on the asset quality, growth trajectory and all. Then maybe one could look at. So in medium term, I see 180 to 200 is being the price band where Yes Bank is likely to stabilize, and how the things pan out from there on after the appointment of the new CEO, we will take a fresh call on that.
180 200 at present the stock is right there, almost 10% downtake is the pre-open rates, what actually is being suggested. Where is the market going to open as per the pre-open rates? Nifty almost going to open flat, Bank Nifty is showing a 45 point cut, BSE in fact mid cap index and small cap index, they both actually are suggestive of a very muted, very tepid sort of opening. So again, a very almost sideways opening is what actually is going to be expected. Almost 1.5 minutes to go. Dharmesh, a quick one, almost 30 seconds. The question is, what is the word at present? Are the markets looking good for buying, or you're very circumspect?
No, I am very circumspect. So my own sense is, unless we get a 200 point kinds of a rally on Nifty on a closing basis, it's to sustain. This is pure technical perspective I am giving you. We cannot expect the market to rally. But what we have seen is all rallies are being sold into, and this is the scenario which is likely to continue. No relief on the currency front as of now. So currency would be a deciding factor from technical and trading perspective.
Getting ready for the 99.50 mark, just about 50 odd points away from breaking that 10,000 mark in trade. Let's see if that happens or not, or maybe a recovery comes in the second half. So it's a weak start to the November series after a disastrous October and September series for the markets. Dharmesh, two stocks from the broader market universe, the top losers on the Nifty 500, Equitas and Ujjivan. RBI has mandated that they need to separately list the small finance banking arms of their operations, and essentially that's what the street is now discounting on these counters. What happens next? If you track these stocks, what's the kind of value that you would possibly give to the small finance banking operation, and therefore how low from here can these stocks go?
See, I don't track them very actively, so won't be able to comment on the type of valuation after the this demerger of business happened. Each of one would attract. But broadly, as far as NBFCs are concerned, particularly the microfinance kind of companies, they are in for a big trouble because of the higher cost of funds. And higher cost of funds, what it does is raises the interest rate scenario, which again becomes a concern with the people who are borrowing from them. So repayment becomes a concern going forward, and the NPA levels and all gets into a rising trajectory. So the entire space, one has to be very selective in NBFC space, which are the companies they are targeting on. So the stock specific approach has to be now very, very critical in this entire space. I think BFSI segment, only private banks are the space where you can find some kind of a comfort. Other than that, this entire zone will keep on getting sold into for some time now.
Okay, so can see further weakness from here on a see it. Dharmesh, auto ancillary, what's the sense if auto demand is going to remain a little soft, and that's the indication that we're getting from at least some managements as well as auto dealers? What happens to the ancillary space? I mean, replacement demand is one thing, but if the sector demand as a whole slows down, then they are going to see some kind of an impact.
Yeah, definitely. I think they are also heading into a tough situation. Though OEM's demand will come down and replacement will be the same trajectory. There won't be any meaningful upside out there. At the same time, what they are facing is the heat from the overseas buyers, because though the currency has helped them, but the protection measure which they have been taking, be it US and likely it would be Europe going forward. So again, the demand won't be so great. Though as of now the exports have been there in place, but going forward I think even that will dwindle. So one has to be careful, and again it's not a good buy given the current macro scenario which they are into. At the same time, input prices have gone up and the pricing power on the blended realization front has come down, so margin squeeze is also there. Valuation wise, they look pretty attractive given the historical track of the valuation multiples where they have traded. But I think around 10-15% kind of a more stock price correction is there, be it Bharat Forge or Motherson Sony, and if it materializes, then that is the time one should look at buying these stocks, because eventually these are quality fundamental stocks, so one has to be invested in them, but this is not the right time. Let's wait for some more correction in them.
Right, Dharmesh, what's the expectation or what's the sense around ITC? The results are due, but broadly where the stock has been largely moving sideways again in the entire correction. What one should be actually doing for ITC, and what should be the expectation for a broader sort of earnings growth?
See, as far as ITC is concerned, and going by the way the actual numbers came up, I think this time there should be a positive surprise on the numbers from the non-cigarette division, that is the FMCG and paper division. That should report a healthy set of numbers along with the agri front. So overall, my own sense is around 11-12% kind of a profitability growth should come through ITC. And the stock price, I think almost it's priced to perfection on the valuation multiples, because the main business contributor has been cigarettes, and there's always been a regulatory and policy overhang on that. So fortunately, the sharpness or the harshness of that overhang was not there in the last 1 year, and this again being the election year, so we won't be having a budget. So they're spared from any further, duty hikes on the cigarettes. But overall, given a choice between Hind Lever and ITC from the FMCG space, I think one should be buying into HUL rather than an ITC, because over a period of time the price appreciation in HUL will be far better than what we can get in ITC. So maybe around 310, 320 is the maximum upside out there for ITC on the valuation multiple, and that's the higher end of the valuation multiple where it will be trading. So as of now, from a trade perspective, one can buy, but from a long-term perspective, I would prefer Hind Lever.